Hello, everybody, and welcome. Today I'm with Liam Boggan. Liam is CEO and founder of Quantmatix, which he would describe, I think, Liam as a market GPS for traders with an emphasis on timing. Anyway, Liam, welcome. How are you today?
I'm very good, Peter. Thank you for having me. It's a pleasure to be here.
Great, fantastic. Listen, Liam, you've done a lot of things in the asset management industry, um, and perhaps this latest episode is the most exciting. But maybe you could take us back to some of the roles you've had and the kind of experience you've had in the market over a long career.
Yeah, well, I suppose everything is a journey, right? And how we got to today kind of follows logically from sort of the path I've sort of have been on throughout my career. So, I mean, I started off my career as an equity analyst, became a portfolio manager, became head of equities at a asset management business in Dublin, where uh, we managed funds for some like global multinationals, some very large institutions at the time. So got a lot of exposure to big clients and large portfolios very quickly. I then succumbed to the dark side and became a stock broker. I suppose that family business I've been involved in selling stuff. So I didn't like being sold to, so I thought I'd start joining the sell side. So I worked in a variety of sales roles and research roles over the period before I suppose becoming interested in kind of market strategy and building a product based on some of the learnings that I had. So I was always the fundamental guy, as in I had a deep passion for learning what companies did, understanding what the management did, analyzing the accounts and the P&L and L and all of the movements within that and overlaying with
Yeah.
valuation. But I did have the privilege of working with one of my best friends in college who was a technical analyst, as in like a chartist. And so we outperformed dramatically while I was working in the as a portfolio manager. And it was like quarter on quarter, year on year, we outperformed all of our peers. And that was through a combination of me doing the sort of that fundamental work to identify companies that we either liked and or disliked, and combine that with market timing tools and techniques so that we could essentially improve the performance of the fund by being overweight the stocks that were going up and underweight the stocks that were going down. It's kind of simple, really,
Hmm.
but sometimes the most complex things really are quite simple if you take it to a high level, right? So that's how we got to Quantmatix, which is a big data AI enhanced uh, web app that covers global multi-asset. We cover thousands of instruments every day, but essentially it's trying to help investors do exactly what I just said. It's trying to help
Yeah.
people who have strong views and opinions to basically to time their investments better, to highlight opportunities where they can make money, to help them avoid areas which are going down. Uh,
That all
and
sounds.
essentially, provide somebody with an overlay.
Everyone should
That
have
that
one, no question.
well,
But
yes,
listen, let me take you back a little bit because I know the genesis of this product came from when you're working with a major custodian bank, like one of the real big ones, and you got a an idea of the importance of institutional order flows. Could you maybe talk us through just how that works in practice
yeah.
and the
Well,
effect it has?
yeah. Well, I have to say I'm an enthusiastic person, but I found this to be absolutely fascinating. So, like, I was already a convert to market timing techniques,
Mm.
but I had never seen um, until I worked for said large institution for a few years uh, that you know, this particular organization, was one of the size players, represented about 20% of globally traded flows, right?
Mm.
So, but what I learned there at first hand was that the world's largest institutions, they don't collaborate, but they tend to behave as a cohort,
Mm.
so they tend to get ideas at around the same time. So while I was there, I'll give you a specific example. I was there in 2011 for the first day that I saw the buying of the banks globally after the financial crash, 2.5 years of selling, and we were able to see that institutionals' weightings, as in their holding in the banks, was basically at an extreme low, right?
Yeah.
Uh, and I saw like day one of buying, followed by day two, day three, day four,
Mm.
and then there followed like a year and a half of every day there being more buyers than sellers,
Yeah.
of banks. And so that was very powerful for me because that proposition that it took this large institutional cohort between, on average, 4 to 6 months to execute a trade, as in to
Mhm.
go overweight or underweight a sector,
Mm.
uh, was kind of dramatic. And again, it was an eye opener for me because I did work as head of research for a very uber fundamental, top ranked equity research team in a broker in Dublin, and we had some really good analysts who made some really good calls, and sometimes they went nowhere, and we could never understand why some of these stocks didn't perform. And
Mm.
then end up in a different role, and you go, it's like the tide. You can't swim against the tide. This was it, and I suppose this comes down to the whole conversation about this company was fundamentally good for a long period of time, but during that period of time, owning it was a waste of time, right?
Mm.
Because it went nowhere, right?
Yeah.
Uh, and then that institutional cohort switched tack, decided that this sector was something that they wanted to get exposure to,
Okay.
and off it and its peers went to the races. So
Yeah.
there's a lot of there's stuff that your average investor really can't see
Yeah.
in the market.
So it's like there's this giant super tanker underneath the surface or whatever. That's not a great analogy, but
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 it but
these
it
forces.
is it is it is like the tide, like
Yeah. Yeah.
you and your super tanker,
Mm.
you will be pushed back
Yeah.
you'll be pushed back if the tide is going against you, no matter how big you are. And
Okay.
that I think
Okay.
was the key message.
And yet, Quantmatix, and maybe you could maybe show some of the people, what that looks like in terms of the interface and the signals it generates. Yet, Quantmatix is a kind of a technical product, which infers there's a kind of a maybe a more short-term perspective. Is that unfair, or
So at Quantmatix, and I'll show you some of the examples over multiple time frames. So
yeah?
we we actually service a range of clients, like from hedge funds for whom a few days is a long time, to like large scale institutions who take 3 to 6 month views on weightings of stocks,
Hmm.
to asset owners, pension funds who are looking to take several years view, right? So we do our analysis across multiple time frames, but so you can see across the time frames how it works. So it's not short term. Maybe the better way to do it is actually show you. I'll just send you a request, Peter, to
Yeah, yeah,
allow
yeah,
me to
sure. Yeah.
share. Okay, so I will share this screen here.
Yeah.
Okay, so you can see that. So that's the front page, I suppose, of the not I suppose that's the front page
Yeah.
of the Quantmatix
Yeah.
um of the Quantmatix web app. And you can see actually we said last week that we thought the Mag 7 is approaching key
Mm.
support levels and it might bounce, right?
Yeah.
Uh, that turned out to be relatively prescient. But I'll just go to the long-term time frame just to address that question first of all. I'll just show you. So this is the S&P. This is like the chart of the S&P on our system on a monthly time frame.
Yeah.
And uh, I think it's worth saying that anybody who participated in the webinars that we did on LinkedIn over the course of last year will have heard us sort of bleat on that the US has been in an unequivocal bull market since this date, which is the 1st of January
Hmm.
2023. So you can see how, on our longer term time frame, instruments move slowly, trade within channels. we had early warnings at the beginning of December, followed by the 1st of February of the market of the market pullback. You can also see that the trading bands, which are proprietary to us, uh, actually work very well, and instruments tend to trade within those within the trading bands.
Hmm.
I'll switch to the medium term or the weekly time frame, and I'll just switch to show the chart on the Magnificent Seven, right? Because this has been the story that everyone was talking
Yeah.
about, and this particularly sort of stonking rally from September onwards. But again,
Yeah.
we started, we had an exit signal in the Magnificent Seven on the 6th of January of this year. We actually had, let's spell it properly, Tesla. Show you the chart on Tesla. We had with kind of impeccable timing, an exit or a negative signal in Tesla on the 23rd of December. So
Right. Yeah, that's pretty clear.
so that's kind of how it works. And again, I know that we want to talk about the challenge for portfolio managers, and the easiest way of doing this is if I just put up the X in it. So just go back to the S&P. So this is our weekly chart on the S&P, and you can see that the signal turned negative on the 23rd of December.
Yeah.
Again, this 17th of February, and it rolled over. But if I just press the constituent screener here, where we've got all 504 stocks that make up the S&P 500, to show you that So this is a view. So your job as a fundamental portfolio manager, so you've got to pick a portfolio of winners out of a universe of 500 stocks.
Yeah.
So your challenge as a fundamental analyst is pretty much impossible. You absolutely can't do it. Right? What
Yeah.
we have here is we have our top Quantmatix signals. Again, we have actually right now, it's kind of fascinating. We have no top Quantmatix signals, positive or negative, but we can show you the stocks which are just on the change now, which are just starting to go positive. Can
Hmm.
add in the ones which are starting to go negative, and then simply what our system is particularly good at is capturing the inflection points when the score is very negative and it's just started to turn around. So may as well
Yeah.
just do this live. So that's kind of what it does. It's very good at getting right to an interesting idea in a very short space of time. This is not a recommendation. This is
Yeah.
just
Yeah.
telling you that the score, and you can see it just here, that the speed and direction score in advanced micro devices has literally just started to turn around. So
Okay.
that's kind of what we do. All of these charts will look kind of the same. So it's fast at doing that. So that's what we do. So
Fantastic.
what we do essentially, and if I stop sharing here now,
Yeah.
is that we try and capture the persistence of the flows
Hmm.
that I had seen said working for that big custodial bank, and we're substituting price trends, basically price as a substitute for the flows, right?
Okay.
And all of the maths work that we have done has been to try and make it so that it is slow moving and persistent, and that you only get one of those signals, positive or negative, when the direction is actually changing. And as we
Right.
say to everybody, early enough to trade, late enough to be persistent. That's
Okay.
the
Okay.
mantra.
And I
So,
know, and I think you touched on it there, the job of the fundamental analyst. I know you have some views on that. It's not an easy job these days, especially in a post-MiFID environment.
yeah, well, I think MiFID has been a disaster for the European financial services industry. I could see what it was meant to do and the good reasons behind it, but in practice, MiFID has been a disaster. So I think you know these are real numbers. Like 70% of active portfolio managers underperform relative to their benchmark. Right? So the only reason that you would have your money in an actively managed portfolio, an actively managed fund, is for it to outperform. And and therefore you get charged higher fees for active management, right? But the guys, 70% of them underperform, right? So, and they've underperformed for many years. The impact of MiFID, which was originally designed to protect consumers from, from their money being used to pay for research without them knowing, kind of thing, um, has been that research budgets. So these guys, remember at the start, these guys are underperforming anyway. Since 2017, their research budgets have been cut by up to 70%,
Mhm.
right? So you are underperforming at the start, and now you have 70% less research budget to spend,
Yeah.
and you're expected to still achieve outperformance.
Mhm.
What happened then was the is that the investment banks and the brokers, because of the research budget cuts on the customer side, they laid off a whole bunch of analysts on the research side, right?
Mhm.
So some extraordinary number, something like 750,000 people lost their jobs in financial services in Europe as a direct result of MiFID, and it hasn't improved people's performance. The corollary of this is that in the US, and I can stand over these numbers, in the US, where they're not subject to MiFID, US portfolio managers pay on average 4 times as much for research as European portfolio managers, but
Mhm.
they also outperform, and they outperform quite dramatically.
Wow.
So if you're an asset owner, so you're like a large pension fund with like billions in your fund, right?
Mhm.
Like that 4 times as much that the US guys are paying is a tiny percentage of the overall assets under management.
Yeah.
But
Scale.
the performance of several percent, and I think the average is about 2.5% increased absolute performance. That's absolutely massive, again, in terms of the context of the spend versus return in absolute monetary terms.
Mhm.
So some of it has been a huge challenge. And again, if you are a portfolio manager and you're trying to manage a portfolio of like 600 European stocks, or you know, it's going to be pretty much impossible for you to stay on top of
Mhm.
all of the news, you know,
Yeah. Yeah.
and so that continues to be the biggest challenge, and that's what that's kind of the purpose of what our product is designed to do, is like
Yeah.
simply get you to be able to spend your research resources, time being the most obvious one, as well as monetary, better.
Mhm.
Highlight the areas that are rolling over and highlight the areas that are actually turning more positive, so you can actively tilt your portfolio.
Okay. And tools like yours, and then, we have AI coming on very strongly now. Where do you think the industry is going right now? How do you think it's reshaping itself and meeting the challenges that you've just described?
Well, I suppose one of the consequences of MiFID has led to like a massive surge in the passive industry, right?
Hmm.
Where active managers who are underperforming are losing their jobs, and then that institution then goes and offers the client, instead of pulling his money to somebody else, to put it into like an index tracking passive fund, right? So that's not going away, right? That you could get exposure to passive. So, but I do think that with tools like ours, which built in AI, and there will be other tools out there. Obviously, we're not saying that there won't be. I think that the whole asset management industry is ripe for major disruption
Hmm.
right now. At a fraction of the cost of having a large team of humans, you can now get to the answer
Hmm.
much quicker. So I suspect I suspect, that if you certainly wouldn't be setting out for any of those very large institutions, if they were going to be started from scratch now, you wouldn't be starting from here. That's classic Irish saying, Matt. But you can do most of you obviously do need skilled portfolio managers, and all of the guys that we know are very skilled at doing what they do. They just there isn't I suppose there isn't appetite for underperformance, if that's another way of describing it. So again, there's technology in terms of being able to get to decisions which are better, faster is one
Hmm.
thing, but also everybody thinks that you go to like a large asset manager, they tell you they're taking 3 to 6 month views. or 18 months use when they buy a stock. But all of their customers have the price of their fund on their mobile phone every day,
Yeah.
right?
Yeah.
So there's no appetite for sustained periods of underperformance. And the guys say, look, I've
Yeah.
got a good portfolio. It'll come right. It's just underperforming the S&P by, 5-10% now. It'll be all right. There's no appetite for that. So
Yeah.
unfortunately, people's time horizons are falling and attention spans and preparedness to endure underperformance have absolutely collapsed. Everybody wants to get the right answer immediately.
In the asset management business, like everywhere else. And where does this leave the old traditional fundamental analyst out there, in this new environment? Is there still room?
Uh, I mean, as I said, all of the fundamental analysts that I know that we've been servicing for years, they're all actually really very good at what they're at their jobs. One of the really interesting things, though, is that given that there's been so much resource taken away, it actually leaves the market open for some really good fundamental guys to uncover really interesting ideas, like stocks which are not researched anymore, stocks which have only got a handful of people covering them. So there's loads of really interesting ideas. You just have to find the right guy who has the right tools to get to that answer, or who has a good nose for unearthing those kind of stocks, right? So there's I think on the one hand, it's a portfolio managers are subject to like an existential threat, but on the other hand, it creates opportunities for the better guys to actually thrive, and somewhere in the middle will be that balance. Well, actually, I think it's going to be a handful of those guys will do very well, and
Okay.
most of them will lose jobs.
Right. Well, I think there's an upbeat note in there somewhere. So
Well, hopefully, yes.
thanks. Thanks a million, Liam. And we'll leave it at that. All the very best to you. And we'll take it from there. All the best. Bye for now.
Thanks a lot, Peter. Cheers. Thank you. Bye bye.